Welcome back. Investors around the world will be watching their screens later today when NVIDIA releases its most recent financial results, and the numbers could affect the entire tech sector. Our next guest remains bullish on tech stocks, but sees more opportunity in sectors like financials, as she expects volatility in tech. Joining us now is Nadia Lovell, Senior U.S. Equity Strategist at Global Wealth Management, UBS. Nadia, great to touch base with you. Again, thanks for making a bit of time for us. You do say you like the technology sector, you and your colleagues at UBS, but you think volatility is likely. Could today's results from NVIDIA be the catalyst for some of that volatility?
Absolutely. Without sort of making any comments on any particular single stock, we all are watching NVIDIA's earnings. It's important for the tech trade and also the AI trade. We know that the AI trade has been powering this market for most of the year, but we do acknowledge that the volatility could pick up in the sector as we approach the fall. The options right now are pricing in a plus or minus 10% move, and that's above the average that we've seen for the last several quarters. But I think even outside of it, NVIDIA guidance will be important. When we look into the fall, you do also have some other potential catalysts in terms of the iPhone 16 launch from Apple. That is expected to have some AI feature, and that's been pulled forward to launch on September 9th. But when you head into October, there's a possibility, Paul, for additional export constraints on AI chips as well as AI equipment. We've seen that over the last couple of years from the U.S. Department of Commerce in October, and what you have seen is a reaction from the stocks have typically pulled back 15 to 20% on that reaction. But that said, the good news is many of these stocks tend to rebound and have reached new all-time high, and that's because the demand for AI chips has been so strong from Western nations and will continue to outstrip supply, we think, for the next several quarters. So we do advise investors to brace for potential volatility in the sector, but don't lose sight of the longer-term secular growth story that's happening in tech, self-funded growth, particularly around AI, and use some of those pullback to opportunistically add to AI as well as tech broadly.
Let's talk about something that has excited the entire stock market, and that's the strong possibility that the U.S. Fed is very close now to beginning a series of rate cuts. You and your colleagues at UBS expect 100 basis points of cuts this year. That implies, I believe, at least one cut of 50 basis points, correct?
Yes, and I would say it's more of the optionality than a certainty of 50 basis points cut. I mean, right now where we stand today, the Fed's focus, of course, has shifted to the labor market of part of its dual mandate. The risk now seems to be more on that side. The labor market has come back into balance, and it's no longer a source of upside inflation pressure, according to Powell last week. And we're seeing that in numbers. And Powell has noted at Jackson Hole that the Fed doesn't seek nor welcome any additional cooling in the labor market. Of course, we'll all be watching tomorrow in terms of weekly jobless claims ahead of payrolls. August payrolls next Friday on September 6th. That will determine the magnitude of that first cut. But we do think the bar might be high for 50 basis points coming out of the gate, because that would signal that the Fed might be behind the curve. The labor market is cooling, but it's not contracting, it's not stalling out. And so you still have an economy that's growing at 2%, inflation that's on course to back towards a 2% target. So it does feel like, yes, the cutting cycle will start. We do think that the Fed stands willing and able to do 50 basis points if the data warrants it, if we see any sort of real weakness. We heard that from Daly as well earlier this week. But right now where we stand, it seems like 25 basis points is more likely for the first cut than 50 basis points, and having the option to do more should the data warrant it.
And you remain constructive on U.S. stock markets. Your target on the S&P 500, I believe, is 5,900.
Yes, Paul, we do think that there's further upside to this market. And when you look at it, it's not all that heroic. It's only about 5% upside from here. We've had a pretty solid rally all year. Now, to get to that 5,900, we don't necessarily need to see a continued broadening out of the performance. We would like to see that continued broadening out of the performance. And we think that that will happen, particularly into some of the more cyclical areas of the market, given that we have Atlanta Fed GDP now that's tracking at 2%. And so it does suggest that the economy is on course for a soft landing. Tech could power us with 5,900, but we think for a more healthier bull market that you want to see that continued broadening out of performance, which we do think that you'll get.
One sector you like, and I believe you have just recently upgraded it, is the financials. Talk to us about the U.S. financials.
Absolutely. So financials, as we know, is more cyclical. Retails is our cyclical exposure in our sector position. As you know, financials has been under pressure due to higher deposit costs and also just anemic loan growth given the higher cost of capital. As the Fed starts to reduce and ease monetary policy, we think that that could offer some relief to deposit beta and potentially a shift in sentiment and help loan growth. You also have, a housing market that's been somewhat frozen due to a lack of supply and that lock-in effect. We're already seeing a pickup in mortgage activity just in the last few weeks as mortgage rates has come on into under 6.5%. And there's also the possibility for continued pickup in capital markets. M&A has been pretty decent this year. We could see a pickup in IPO. And there's a possibility for easing the regulations and capital requirements as we approach to Basel III endgame. So we think that financials is positioned for outperformance as we head into year end.
And why don't we finish with the utilities? You like that sector as well?
We do. Utilities is our defensive play, but remember, utilities also has exposure to that AI trade. I mean, power is quite needed for to power up these data centers, and there's strong demand for that, and there's just not enough supply to meet that demand. So utilities does have that secular exposure as well, and it's not sort of a traditional defensive play, but it does still have that defensive characteristics. So we think that it offers a balance of both, especially as we enter probably a more volatile period for equities.
Nadia.